Hey folks, hope you're all well and welcome back to the Market Structure Education series. This is the final video I've got planned in the Market Structure series, and we'll look here at how we tie everything together that we've looked at so far to build out the narrative for entries and exits. We'll look at an example again from Dixie on what a trade built around this narrative might look like. As always, if you've not watched the previous videos in the series, I'd recommend looking at those first, and I'll link them on the screen now. Our goals for today will be essentially tying the full series together, so we'll start with a quick run through to remind ourselves of structure, ranges and points of interest within those ranges. We'll have another look at range relationships and some of the relationships that I use to frame trade setups. We'll remind ourselves of how we use these pairings to form a narrative in terms of the direction that we're going to take trades in. And finally, we'll look at all of this on a chart example on Dixie to have a look at that trade setup and how we work it top down. So full disclosure, the trade we'll look at later isn't a trade that I took live. I don't trade Dixie as a chart on its own. It's just an accompaniment chart for me, as it's correlated either directly or indirectly to the assets that I do trade. But I wanted to find something that existed on this chart, given this is the example we've been using through the entire series, so I did have a look back in history. So yes, this is a cherry-picked example from the Dixie chart, but if you look in your own charts, at any charts at past data, you'll find this is something that presents itself a lot as an opportunity, and the overall pattern top to bottom as well as the entry model is something that I do trade regularly in multiple assets, so I'm confident in this as a setup. I just want to be clear that it's not an actual trade that I took. It's just an example on the chart that we've been using. So first up, let's have a quick reminder of single time frame market structure. So this is the same schematic we've used through the entire series so far, and it just depicts the major highs and major lows within each time scale. So the point here is that this fractal or this structure will exist within each time frame that you look at, and the identifying the major highs and major lows within that time frame is just something that takes a little bit of practice and a little bit of time. The key thing is that however you're doing it, you're consistent with it, and whatever model you find that works for you, whether that be using the wick highs or wick breaks of structure, or if you're using 38.2% retracements, or if you look at pullbacks as having to have a requirement of 3 candles in the opposite direction, or whatever it is that you decide is your structure for identifying the swing highs and swing lows, be consistent with it. There are many different ways to do it. I'm sure I do it differently to other people, but it works when you're consistent. That's the main key. So we've discussed before, price is never this clean. It's never this clean when you look at a chart. The idea here is just to look at the fractal in terms of when order flow is bullish, you'll see rising highs and rising lows. When you're in a potential reversal scenario, you'll see a shift in that structure where one of those points being taken out, whether it be the low being taken out in a bearish reversal or the high being taken out in a bullish reversal. And then you'll see order flow flip in the opposite direction. And in this example, you see bearish order flow then is lower highs and lower lows. And that fractal exists on every time frame, but this is how it looks from a single time frame perspective. So next up then, just a quick recap of the multi-time frame structure. Again, we've used this diagram before. The lighter line is the lower time frame structure, and the darker line is the higher time frame structure. And the main takeaway here is just that within every leg of the higher time frame structure, you'll see a fractal or close enough to a fractal of that higher time frame structure. So if we look at the first up and down on the left hand side of the higher time frame range, you can see inside that the lower time frame or higher time frame -1 has the full higher time frame structure start to finish within that. Again, it's never going to be this clean. It's never going to be exactly 3 highs and 3 lows, or 2 highs and 4 lows, or anything. It's always going to be a different number. The main takeaway is that when I talk about price being fractal, I mean, many people talk about price being fractal. This is what we mean. That the movement that we see on the higher time frame is replicated on the child time frames, if you like, if you consider the higher time frame the parent time frame and the lower time frames are the children time frame. the fractal is replicated on those child timeframes, and that can give us a clue as to where the higher time frame is going to go. So that's the multi-time frame example of structure. And this is just a quick example of that on the Dixie chart. So we can see here in the middle section of price here, where the H4 highs and lows are marked out in terms of the light pink path, and the higher time frame structure, which is the daily, is marked out in the dark path. So if we look at this middle section between the low at the bottom and the next low, we can see we have one long impulse and then a few shorter impulses of highs and lows on the H4. H4 lows broken, and then we see some bearish order flow on the H4 before the H4 finally breaks bullish again, and that causes the daily to move on. So again, just look at this as the H4 structure inside the daily structure, but that one single up and down leg of daily structure actually has a full fractal of multiple ups and downs within the H4 structure. So it's a full fractal of the overall move. And if we were to look inside those H4 impulses, the first up and first down, for example, we would find at H1 and M15 level, again, there are multiple of those fractals within that. So just a good example in the chart of how it looks. Next refresher then, just on single time frame trading ranges, so won't dwell on this one too long, but this is the daily Dixie example, and the trading range is essentially just the previous major low to previous major high, or major high to major low, defines the trading range. Key areas within that are equilibrium of the range, which is the 0.5, anything above that is premium and anything below that is discount. And we have the OTR range within that, so 618 to 786 in the retracement direction of order flow. So in this scenario, the order flow is up, it's bullish, so the retracement levels are in the lower portion within discount. So that's a single time frame range. And then taking that to the next step is the multi-time frame ranges and how to look within each other. So this is the weekly time frame on Dixie, with the weekly range marked from weekly major high to weekly major low, and then within that we see the daily range, which is the daily low to daily high, and we can see that the daily range sits almost exclusively within premium of the weekly range. There's a little bit at the bottom which is in discount, and that's where it's moved back to at the moment within the Dixie chart. So may go lower, but that's the relationships between the ranges when we see the daily range inside the weekly range. So in this scenario, and we'll look at this in a second, the weekly is bullish and the daily is bullish and the H4 is bearish, so we read that as a daily retracement, so we're looking for retracements inside the daily range. If the daily range low was to break by candle closure on the daily, then we would be looking at that as the daily retracing the weekly, and we'd drop into the weekly range, and we'd be looking for points of interest in the weekly range where the daily may well pull back to, in order to continue the weekly impulse. So as I say, we assume continuation until proven otherwise, and that proven otherwise is on the time frame that you're looking at. So the weekly impulse will retrace on the daily, and if the daily breaks structure, then we're looking for where within the weekly range it might retrace back to in order for that continuation. Same for daily and H4 and H4 and H1 and so on and so forth. So that's how the ranges look inside each other, and how you drop up and down through the ranges depending on what time frame is the one that's at odds with its parent. So in this scenario, monthly is in confluence with weekly, which is in confluence with daily. The one that's at odds is the H4. So the range that we're concentrating on is the daily range and the H4 within it. If daily breaks bearish and it moves from confluence with the weekly, then we drop into the weekly range, because the daily is now not in confluence with its parent, and that's the range then that we're looking for. So I tend to look at the key range as being the one that its child has broken against it, and that's the one that I'm concentrating on points of interest. So that's the multi-time frame ranges. And then we'll look at points of interest within those ranges. So there are many different points of interest that you can look at. I'm not going to go through them all. We spoke about order blocks, rejection blocks, breaker blocks. We spoke about fair value gaps and liquidity voids. These are all ICT concepts, so if you want to learn more about those, then again recommend you go direct to source for ICT. But really your points of interest within these ranges can be whatever you want to use to trade, as long as you've back tested that and you're comfortable or confident that it's going to work for you going forward. This example here shows a weekly fair value gap, so the weekly range fair value gap and weekly discount, and it shows the daily candle at the moment has hit that within the daily range. So that might be somewhere that we're looking for a change in structure on the lower time frame. So in this scenario, I'd be looking for a change in structure here on the H4 to signify the H4 is turning back to confluence with the daily, which is already in confluence with the weekly, which is already in confluence with the monthly, and we'd see range expansion on all of those time frames in that scenario. So the daily range expansion to range high, which would take the weekly range high, which would take the monthly range high as well. So that's how we use points of interest within the ranges. It's essentially the time frame that you're on plus the one above. So if the daily is the chart that you're tracking, then you'll be looking for daily points of interest, but more importantly weekly points of interest within the weekly range that the daily might retrace back to. So point of interest within the range. And last little reminder slide. So this one is just highlights how I use the pairing of time frames in order to make that work. So the range relationships. So essentially the parent time frame, if the parent time frame is equal to the child time frame, so high time frame is equal to high time frame minus 1 in terms of the order flow, then I would expect continuation of that parent order flow. So we'll be looking at the parent range extreme. So if it was a bullish order flow on the higher time frame and the child time frame was in confluence with that, you would be looking for continuation to the range high of the parent. Conversely to that, if the parent time frame is not equal to the child time frame in terms of the order flow, so if the child time frame breaks against the parent time frame, so we always start from parent, so the parent one is the key, that's the most important one. Higher time frame is always most important. But if the child time frame then breaks against that, we're looking at that higher time frame or parent range being in retracement at that point, and we're looking for points of interest within the range, so internal range liquidity, where that retracement may head back to before continuation of the parent order flow. And a quick look at the pairs I use there. I won't read through them, but these are just some of the ones that I use, and the example we're going to look at is actually the H4 and M15 pairing. So that skips the H1. I still use the H1 within that for confluence and targets, but H4 as a higher time frame parent and M15 for entries is quite a good one. It's one that I like. In terms of finding your own, that just comes through testing for whatever will suit your style, suit the type of trades that you want to do, suit the asset that you like to trade or assets that you like to trade. So you need to find that yourself through back testing. So let's jump into a little example then of how you would use all this together to pick entries and potentially make trades. So we'll start on Dixie again. We've been using that as an example. So we know I'm not going to go from weekly and monthly down because you've seen enough of that already to know that the monthly Dixie is bullish, the weekly Dixie is bullish, and the daily Dixie is bullish. So this is the daily range that you see here. That's on, and within that daily range the H4 has broken bearish against the daily. So this is the H4 structure. So we can see here this was H4 and daily impulsing together. Daily finds its top, H4 breaks structure and starts moving against. We get this one little break back here, it doesn't come to anything, then we break lows again, set a high, low, high, and we're currently setting another low. So the H4 is very much in bearish order flow here against the daily, weekly and monthly. And the part I want to concentrate on, I'll put this in replay mode. The part I want to concentrate on is this part here, just so we don't cheat and see that through there. So at this point, H4 has broken bearish. So in here, as I've said this in a previous video, there might have been some losing trades as you were looking for a pullback here and then range expansion, taking this as being a legitimate retracement into discount followed by a bullish break of H4, so you're looking for range expansion. So I think this is quite an important one to leave in here, just to make the point that there is no surefire thing. There's no 100% trading mechanism in markets. So you have to be good at losing. You have to make it okay to lose, and make sure your risk management is on point, so that when you are losing trades, your losers lose less than your winners win. So when this broke here, I was looking for potential entries within the retrace of this range to then go and expand this range. Now, as I said, I don't trade Dixie, but this gives me an idea of where the assets that are conversely related to, or inverse correlated to Dixie are going to go. So I did take a few losses on risk assets, basically looking for them to go short when I thought Dixie was going to go long. So it didn't quite play out. But at this point, when this high gets wicked, it's a sweep of this high, and then we start moving down and we break this low. This is us back into bearish posture on the H4, and you'll be looking at that H4 range at that point in time from here to here. So I'll stick the OTR of that range on first, and then I'll put the range itself so you can see the discount and premium areas of it. So this was the range at that point in time. Now there was in here a fair value gap. We can see that here, so that would have been a point of interest that I probably would have been, or I was looking at that point in time for Dixie. So this one. Now the reason I would discount that or be wary of it is that it hasn't reached then back into the premium level at that point. Most of this gap is still in discount of this range, and we'd really want to see it a little bit higher. You can see it did have a couple of reactions to it, but there was nothing there in terms of, for me, if I was looking for a short here, I wouldn't short that, because I don't want to short discount, I want to short from premium. So when this kind of broke and then continued, you're looking up here. So you've got a little fair value gap there that's kind of already been filled and played out. I would have discounted that one. And the area I was then looking at was this order block here on H4. So there's the bearish order block there, which falls around about the 786. And the way I would use this is, we know where the daily is and the weekly is. The H4 is now retracing, which means that the H4 order flow is bearish. We know the H4 order flow is bearish, but for the H4 to be retracing, the H1 must be bullish. So if you remember what I said a second ago about you want to look at the time frame where the child time frame is at odds with its parent. So within here, I'd be looking at the H1 to see what the H1 does when it hits this H4 point of interest. So if I drop down to the H1, now this is probably going to give the game away a little bit, even though we're in replay, but I'll stick the H1 structure on anyway. Where are we? H1's here. So the H1 structure is here. So we can see at this point it broke the H4 low, and then H1 breaks bullish. It's still bullish through here, still bullish. It's getting towards if I run the replay forward a little bit. I appear to have lost my replay controls. Okay, I'll just switch that off for the purposes of the video. No. So it's still bullish through here, still bullish, still impulsing, and then as soon as the H1 gets inside of this range, or inside of this H4 point of interest, this is where we're looking to see if there's going to be a reaction, and the H1 is going to flip in confluence with the H4 again and signify that the retrace is complete, and we can start looking at the H4 low for continuation. Now, how do we identify that the H1 has turned and it's looking to flip? Well, the same way we done the H4, we drop a time frame. So M15 is where I would then be looking here. So as soon as that H1 hits that point of interest, I don't want to go in blind, because you can look at this one, it has a reaction, but it could continue on. So I want to see something that tells me that it's okay to get in here. So if I look at the 15-minute structure, we can see on this chart that when the H1 is impulsing and finds its way in here, the 15 minute then breaks a low here. So this becomes a breaker structure. And that for me is enough to signify that the 15 minutes about to change. And at the very least, the H1 is going to retrace, and the H1 range at this point in time is this low here to this high here. So there's enough of a range there that if the M15 has broken structure, which it has, and it's going to retrace back into its range, then even if the H1 is just in a retrace here and it's going to continue, there's enough that I can take profit at this low. If I'm going in here, I can take profit at this low, protect the trade, and then look to move lower. So that would have been where I would have been looking, inside that 15 minute range. The displacement here causes this little fair value gap, which I can tell by looking at it that it's above equilibrium of that M15 range. So that would have been where I'd be looking. And this is something that happens over and over. And as I say, this is an ICT concept, so feel free to have a look at this on his channel if you want to understand fair value gaps and the concepts behind them. But that essentially is where I would have been looking. So even if we just, for the purposes of for being quick, just put the fair value, put the short trade on at the bottom of that fair value gap, you're wrong, your trade's wrong, so your stop goes above the high, and then you're targeting just below that low, because we expect that low to be taken. So in terms of the actual trade itself there, that wouldn't be enough for me to go in 1.42. I like my risk reward to be higher than that, so I would probably then look at the top of that fair value gap and decide that I wouldn't want to be involved in that unless price went back to the top of it. As you can see in this scenario, it went higher than that, so it would have caught. But it's just to try and keep the risk reward consistent. So below the low and of the 15 minute range from the fair value gap, where your risk secured above the high, that would have been first partial at that area. But then we also know that at this point we're looking for range expansion or reversal on the H1, and for us to see reversal on the H1 from this H4 point of interest, we would be expecting the 15 minute to drive the H1 low to be taken. So the H1 low is down here, so the first partial here is essentially used to secure the trade and get out with a little bit and take all the risk off the table. And then the second partial, you would be looking at this H1 low, and that gives you a little bit better in terms of risk reward. So you take a bit out there, leave a bit on for the H1, and then on top of that, if we work back up, the H1 breaking structure from the H4 point of interest tells us that it is likely now that the H4 is going to go on and break its structure. So this is the H4 low here. So we would leave a portion. It wouldn't be a huge portion, it would just be your runner. You would be mostly out and completely de-risked so that you can go back and put the money in the market at that point in time. But if you had left this runner for that H4, you can see you get a fairly big risk reward for that. Don't be confused and think, oh well, we can do that with a 15 minute and we can target this if you target the H4 low from a 15 minute break, you're going to have a far more losing trades than you have winning trades. In my view, it's always best to take the range liquidity, the external liquidity on the time frame that you're getting in on. So this is a 15 minute entry, so you want to take the liquidity at that 15 minute range. It's an internal range entry, so it's an external range exit on the 15 minute, which is why you take the liquidity below the low, and then look to leave something in for the time frame up range, which is the H1 in this scenario. At that point you can then decide how much you want to leave in, and it might only be 10 to 20% of your trade you're leaving on the table for that, just as a runner, completely secured, and then you continue to trail the stop up. So you might not reach the H4 low because you might be trailing your stop up and you get stopped out sooner than that. You might have trailed your stop when it broke the low and then had this retrace and then went again. You might have trailed your stop to here, and then you might have trailed your stop to here, and then you might have trailed your stop to here on this open, which might have got whipped out there, or you might have waited until it broke this low and then trailed it to here. So you can trail your stops down to see where you're at. But the key point is, you can see how we build this down from weekly, daily, 4 hour point of interest, H1 turning within that 4 hour point of interest. What signifies the H1 turning? It's an M15 breaker structure. We enter on that M15 breaker structure if we see displacement. Again, another ICT concept. We see displacement, we see a retrace back in that. There's a good area to take risk off. We've got a good area for target 1 for the first partial, which then de-risks the trade. We can move the stop up at that point, and we've got a good target for T2, which is the parent time frame range that we expect to be taken out. So in this scenario, the H1 low. So you can see that although I'm using the 4 hour for my high time frame and the 15 minute for my entry time frame, the 1 hour still plays a key part in terms of that's where I'm looking for it to turn, and that's then a target within the overall framework. So that's an example of how it all works and hangs together, and how you would then build a trade out on the back of it. As I say again, I didn't take this trade on Dixie, it's just one that I found on the chart. That's a good example of a model and patterns that I see often over and over again, and a model that I do use with that higher time frame point of interest with lower time frame entries within that. Test it for yourself, get the hang of looking at these on charts and how they work for you and your mindset and the assets that you want to trade, and hopefully they work out for you. And that's going to close us up for the series. As always, thanks for listening. If anybody's got any questions about anything that was in this video or any of the series, then feel free to link it in either the comments or social media or in Discord if you're in the Discord, and I'll try and get to the answers. Enjoy the rest of your day. Until next time, stay safe. Matt T's it. Gotta go.